From across the European Union as they weigh the risks posed by rising Eurozone inflation. Now, they spoke to Bloomberg from the Societe Forum over the weekend.
I don't think that it should come as any surprise that there is a spike in inflation right now this year.
We are not concerned by the current level of inflation in the EU or everywhere in the world.
Inflation is very much influenced by energy prices and food prices.
All the institutions consider that it will be a transitory feature, and we have to avoid that it becomes structural.
We think that this increase is a temporary one.
We are monitoring it, and we should monitor it very accurately, but without going to conclusions too soon.
We remain vigilant, but we are not concerned.
It is a natural feature of a very strong recovery that we're witnessing.
Well, European finance ministers are speaking about inflation at the Societe Forum in Italy. Well, joining us now is Kit Jukes. He's Chief FX Strategist at Societe Generale. Kit, good morning, first of all. Let's talk about the dollar, second of all. After that jobs number on Friday, what happens to dollar now?
I think we're in a period where it might be softer for a week or two, just because we're back to a relatively risk-friendly environment. People are going to be less pessimistic about China. It still looks as if the first Fed rate hike has been firmly kicked into, if not the long grass, the 2023 grass, which is too far away for me to think about it too hard. And the markets are willing to, at the moment, look through the Delta variant and say, yeah, look, this is a temporary phenomenon. Now we'll see where we go. The next leg up for the dollar, I think, in the long run, it comes really when we focus on the timing of the Fed rate hikes and really get back to looking at the front end of the US curve. And I suspect the next worry about that comes from the belief in the market that a lot of these policymakers are a bit complacent about the inflation outlook in the next 6 months. I think we're going to get at least one scare on that front.
At least one scare on the inflation front. Kit, where is you talk about the importance, of course, of the taper and the timeline. Where is your timeline now? How have you changed that view on the back of the jobs numbers on Friday?
The jobs numbers, I think, just means that the idea that we get a taper announced at the September FOMC meeting is pretty remote. That means it gets announced at the beginning of November. That in turn means that it's really hard to have finished the taper until late in 2022, and then if there's a gap of any kind, we're into 2023 for the first rate hike. So I think there's a lot of movable parts in terms of how the economy reacts and how the markets react to tapering, but it's a long way out now. That's really what the jobs number did. It reinforced the Jay Powell message.
Kit, what's scarier in your eyes, deflation or inflation?
In my eyes now, inflation, just because of where we've gone. It's interesting, we've had 20 years of being scared of deflation, if you like, since Alan Greenspan gave us 1% rates at the end of the Asian crisis, and we've had equity markets that have gone up such a long way since then. And I think inflation is scarier now because of the asset price inflation that we've had, that squeezing inflation out could be very painful. It's I was half thinking you wind the clock all the way back to 1971 and President Nixon, when he was really worried about jobs, not inflation, when he got rid of the gold standard, got rid of the Bretton Woods system. I think now, I don't know whether there's complacency about the medium-term inflationary dangers, but inflation and having to hike rates and fight inflation, even in slowing economies, could be pretty painful because specifically of what we've done to asset prices and to debt levels over the course of the last 20 years.
Kit, what is your view then on commodity currencies? Is the bearishness that we've seen in some of the commodities FX overdone?
Yes, but it's likely to be persistent. But it's not just that they're commodity currencies that traded on the back of the Chinese issue. You've got a lot of individual political stories in places like Chile. You've obviously got somewhere like Australia where, in between rolling lockdowns and an exceptionally dovish central bank, the currency looks dirt cheap to me, and I can't think of any reason why it would get significantly stronger with the current arrangements in place. So I think the commodity currencies need, a decent following wind kind of a defeat of the Delta variant, return to more positive global growth story. There's quite a sort of an army of things that need to fall in place to get them going higher. But let's be fair. This year's top currency is the South African rand. So there's money that wants to go and look for yield, wants to go for these growth stories if it gets unleashed. But it's still just messy, more than easy to turn around and say, let's just go and buy them all.
Kit, I don't know. I mean, I don't know if you have big thoughts on the coup in Guinea or aluminium or bauxite, but does it actually point to supply chain constraints? I mean, it's incredible that a coup. I know they're a country that's very rich on bauxite. Leads to aluminium actually at a 10-year high. What do you do with these supply chain constraints? Are they bigger and actually more aggressive than expected? And so, do you worry about the world economy in 6-8 months?
I think we worry that they're pretty big, but they're a vulnerability for the global economy. They're pretty big in the short term. By and large, what happens is they spike up and we find a way around them. So you get a period where this causes short-term pain, but not more than that. The kind of the geopolitical dependence on some specific countries to provide us with a whole load of raw materials that we need, and specific countries that many of us can't find on a map and don't understand the domestic politics, is something that we're going to have to live with. But so far the pattern has been we find a go around, we find a solution after a scare.
Look, Francine talked about the growth prospects, global growth prospects, and you're right, the complexities of issues like Guinea. When it comes to China, obviously a major component of that global growth, you're looking at a yuan that has been relatively stable despite all the regulatory changes we've seen, trading in a tight range for the last 3 months. Does that continue, do you think, for the Chinese currency?
I mean, it's clearly, another reminder. I mean, A, the yuan is incredibly important. B, the yuan is not a free-floating currency. There's absolutely no way it would be here. And I think C, perhaps more important than anything else, the Chinese authorities have clearly decided that while they try this juggling act of containing some sectors of their economy while trying to get enough growth for others, which is a really difficult juggling act to get right, one of the things they don't need is the additional headache of a volatile currency. So I think it can weaken more than it can strengthen, because that's the balance of risk from here. But I don't think it's going to cause major ructions. It's in terms of something like the euro, if it would get significantly stronger, it would let the euro rally up above 120. I don't think that's going to happen. Yeah. But I don't think we're heading back to 7.
But it's exciting because it's ECB week. What are you expecting from the ECB on Thursday?
Noise, lots of noise, not lots of action, but lots of noise. Well, we've got hawks in town. There's a debate. There is a debate coming out of the ECB in terms of what to do about policy normalization. Maybe someone at the ECB will use the word tapering, which has never happened. But so there is a debate to be had. But in the great scheme of things, the ECB is stuck at less than zero rates. And it's going to be there for a very long time. And that bit, unfortunately, doesn't change.
OK, we'll have to brace ourselves for that noise, hopefully cut through some of it when the ECB meets later this week. Kit, thank you, as ever, for your